On Monday, U.S. President Donald Trump announced that planned military strikes against Iran had once again been delayed, citing what he described as serious negotiations brokered by Qatar, Saudi Arabia, and the UAE. The S&P 500 promptly rallied. However, on the same day, Iran formally launched its Persian Gulf Strait Authority, a toll-based maritime regime that, according to Tehran, means traffic through the Strait of Hormuz will not return to its pre-war status. And according to the International Energy Agency, the global oil market now has roughly 2 to 3 weeks before it crosses what JPMorgan analysts are calling operational stress levels. So in this video, we're going to explain why financial markets and the physical oil market have so dramatically diverged, what the IEA's latest inventory data actually shows, and why a growing number of analysts now compare this moment to 1973 rather than 1990. Let's start by putting the current situation into some context. It's now been roughly 80 days since the U.S.-Israeli strikes on Iran began on February 28th. And despite multiple ceasefire announcements, including one in early April that Trump himself has since described as being on massive life support, the Strait of Hormuz has effectively remained closed. According to multiple maritime trackers, traffic through the strait is running at somewhere between 5 and 10% of pre-war levels. For context, the strait typically handles around 140 vessels per day. In the week of May 11th to 17th, just 55 vessels transited, up from a wartime low of 19, but still a fraction of normal volumes. Roughly 1,000 ships are reportedly stuck in a holding pattern in and around the Gulf. And on May 18th, Iran institutionalized this new reality by launching the Persian Gulf Strait Authority, which charges vessels up to $2 million per transit, payable in Chinese yuan or Bitcoin. Moody said this week that a return to pre-conflict shipping volumes is unlikely in 2026. So that's the geopolitical picture. But what's now alarming analysts is what's happening underneath it in the physical oil market. According to the IEA's May oil market report, global commercial oil inventories fell by 129 million barrels in March and a further 117 million barrels in April. That's a combined drawdown of 246 million barrels in just 2 months, a pace the IEA describes as the fastest on record outside of the 2020 pandemic. The agency now says commercial inventory buffers are being measured, quote, in weeks, not months. JPMorgan has been more specific, projecting that developed economy inventories will hit operational stress levels by the first week of June. HFI Research has labeled that same week the point of no return, beyond which the market shifts from manageable tightness to outright physical shortage. And Capital Economics warned on May 18th that even under a contained scenario, Brent could average $150 per barrel over the next 6 months. The IEA has already deployed roughly 164 million barrels from its coordinated 400 million barrel emergency release. The U.S. Strategic Petroleum Reserve has been drained to around 374 million barrels, its lowest level since July 2024, with a record 9.9 million barrels drawn in a single week. And critically, according to SocGen, even if the Strait of Hormuz reopened tomorrow, the lag between physical flows resuming and barrels reaching refineries is a minimum of 52 days. In other words, even a June reopening cannot produce physical relief before August. This brings us on to the historical comparison, because the disconnect we're now seeing between equity markets and the physical commodity market is not new. In 1973, the S&P 500 initially shrugged off the OPEC embargo on the assumption it would be resolved diplomatically. The eventual peak-to-trough decline was between 48 and 52%, and crucially, the worst damage came after the embargo was lifted, as inflation and broken supply chains worked their way through the economy. The 1990 Gulf War, by contrast, saw a sharper but much shorter shock, with the S&P falling 16 to 18% before rebounding 26 to 29% in 1991. Analysts, including those at the Oxford Institute for Energy Studies, argue that the current crisis structurally resembles 1973 and 1979 rather than 1990 because the disruption is not a temporary political closure but the result of physical infrastructure damage. For scale, the 1973 embargo removed roughly 7% of global supply. Current shut-in capacity is estimated by the EIA and IEA at between 10.5 and 14 million barrels per day, or roughly 11 to 13% of global demand. Ultimately, the gap that IEA Executive Director Fatih Birol has called dangerous is the gap between what the futures market is pricing and what physical traders are reporting. War risk insurance premiums are now reportedly 20 times pre-war levels. A $40 billion US-backed maritime reinsurance facility has reportedly failed to attract buyers because commercial insurers refuse to underwrite Iranian military risk. And Trump's Project Freedom naval escort initiative has so far failed to attract meaningful commercial shipping participation. Chevron CEO Mike Wirth has explicitly warned that the world is moving beyond a price shock and into physical shortages, while Birol himself has described this as the biggest energy security crisis in history. Whether the early June timeline projected by JPMorgan and HFI Research actually triggers that transition remains to be seen. But what the data does suggest is that the diplomatic pause being cheered by equity markets this week does very little to address the physical bottleneck that has been building since late February.